Good morning, everybody. Happy New Year's Eve, 12/31, final day of trading for the year. So officially, how does this make everyone's 2025? Hopefully profitable, hopefully very profitable. And 2026, are we excited to trade? Are we nervous? We'll tackle it. We'll figure it out. It's 2026 is weird. It's um a lot could happen and nothing could happen. It's honestly like this feels like one of the cleanest slates where it's like, well, I don't really have any big plans outside of trading, maybe 6 to 12 months. If I'm going 6 to 12 months, it is like 40% room for error, 50% room for error, not exaggeration. And then it's kind of letting the markets set up with what looks, promising structure, good confirmation, good technicals. And we got plenty of strategies to tackle the market day in, day out, week in, week out, and not be over trading, no crazy risks, and then we'll figure out what the market's hand is going to be. Um, I'll throw this out there as far as where the market could take us in 2026. I think if we have a correction early, I think I just saw something. It was like Michael Burry says Tesla's overvalued. Was that headline? Messages, headline news. Where's news? Watch list alerts. Anyway, um, let's go 2026 scenarios. Correction, then rally, drift, drift, drift. Um, Rally hard and breakdown. These are kind of three scenarios I can see playing out in 2026. So I think it's fitting that we kind of make this the end of the year discussion. Um, I think one of the easier trades would be this one. We're sitting at all-time highs, or very close to all-time highs. How about a little correction? Buy the dip. Everyone's happy because our dip is met with buying power or buying flows back to highs, structure, then holds. Does this roll over eventually? Maybe. I don't know. It's just how can we kind of look at the market as a positioning opportunity for 2026. Drift. This is probably, to me, the one that I feel like I won't participate enough in, but it would be really good for like near term, like weekly to monthly income. If this was similar to 2017, the entire year was slow and steady, low volatility, and the market went higher the entire year. I could see something like that. If there's no surprises during midterm elections, I could see if we start out in this low volatility environment and a lot of uncertainty is kind of squashed. Yeah, I could see another one of those wild years. But that, especially in a low volatility market, if we saw like VIX at 15 the whole year, um, well, that squashes the idea of getting long the VIX. That was so 2017 was like. I mean, I think our highest spike on the VIX might have been in the 20s. In 2017, it wasn't much. Like we're talking like 1 to 2% dips, and it was just every month was positive. I'm going to go back to the chart and see what a year was. I think it was like a 16 or 18% year in 2017. I think um, it could be less than that. It could be like 12 to 13% as well. But that to me is the one that's difficult to participate in as far as like big picture trading because it's not something you're just like, well, it's all time highs. I'm gonna kind of wait for a dip. Well, it never happened. We didn't have a dip. Okay. Rally hard and breakdown. That would be, we had our high in October, and then we had our breakdown. I'm trying to think how this play out. High in October, a little bit of a correction through October 10th, back up again, breakdown on November 20th, rally up again, and we're sitting right here. This is kind of what we've been dealing with right now. So if we come into the new year and we start to rally really, really aggressively, okay, and I would say, I don't know, 5%, 10%, like in the first 5, 6 months of the year, um, I would just be looking for that structure to break. So if the market gives us a big pump early in the year, I think we could come back and kind of neutralize that at the end of the year, which doesn't make for a fun 2026 if we, have a lot of gains in the first half and then it's all just fighting the market the second half of the year. That's certainly happened before, but 2022 had a bit of that feeling. I was long inflation into 2022, had a great like first 4 months and was sitting on almost 15% profit. And then by the rest of the year, um, I was fighting the market and only squeaked out like an extra 4%, like 4.5%. So from um, April, May, most of my gains were in, and then the rest of the year, when the market really was rolling over hard across everything, bonds were down, equities were down, currencies were difficult unless you were basically in the yen or the dollar. Um, it was just a year that I had to fight the market the entire time after my gains were put in. So three scenarios, correction the rally I think would be easiest. Drift, drift, drift would be challenging, but also great for near-term income if you're just trading, weekly and monthly strategies. Let's go to SPX. Let's go to the yearly candles. I'm curious what 2017 was. I'm pretty sure it was a double-digit year. Here's 2017. So off of our 2008 financial crisis, 1, 2, indecision in 11, but 1, 2, 3, 4, 5, 6, 7, 8, 9. That was our ninth candle before we had a volatility event 2018. 2018 was a negative year, by the way. So every single month of 2017 was positive. The open 2251. It's crazy to think like the SPX was at 2251 in 2017. It's like almost triple that now. I don't know about that, Rick. We'll see. I mean, inflation has to be cooperating for us in order for the Fed to really be dovish. Um, it would be a disaster um, to let inflation run like hotter again. Um, I don't think I don't know. I don't think the Fed is going to do it. I think Trump can, you know, kind of pull in whoever he wants Fed wise, at least, the two or three people. But it's like Scott Bessent's influential in this. It's, Trump is the headline for everything. But ultimately, if inflation catches up, inflation will squash every plan that we have. You'll break the consumer, you'll break businesses. Inflation is good for asset holders, um, but it puts things out of reach for a lot of people. So I think, especially the consumer, um, everyone knows inflation, everyone feels inflation. It's on everyone's map and radar. If it's being talked about like it's persistent and it's becoming a bigger problem again, or it's rearing its head again, I think you're going to see just sentiment in the toilet. Eventually, that's going to break something. So I don't think the Fed will just cut rates, cut rates, cut rates because we're trying to. Because remember, all we are doing is cutting rates on the short end of the curve. The only thing that's improving as far as rates going down are near-term business loan, like near-term loans. Like if you're borrowing within like a 1 to 3 year window, then you're seeing lower interest rates. But everything that's 5, 10 plus years, a car, if you're refinancing student loans, they'll be with you forever. Um, and houses, the 30-year mortgage, those rates have not changed. I mean, we're stuck at like 6.2, 6.25 for mortgages. I just talked to a buddy of mine that's moving from Alabama to California. Their rates are between like 6.5 and 7.5 right now, or for the houses that they're looking at, which is kind of crazy. So it's high, man. And prices obviously have gone up a lot the last 3, 4, 5 years on houses. So, all right, let me get this. Roughly 2017, the market was up. What? Is that right? No, that's 19. I was like, there's no way that was up 30%. That was a reflexive rally from the volatility that we had back in 2018, 30% in 2019. That was crazy. Uh, we were up around 18 to 19% in 2017, but it was every month. If we go to a monthly candle, go back to 2017. Let's start in, I mean, every candle was green, or I should say every candle was higher. Even if we had a pause candle, it still technically closed higher. First time in history that the market did that. So 2017 started right here. Put a vertical line. So that little guy right there. So that's January. Bullish, bullish, closed higher, even though it was red, closed higher, closed higher, closed higher, closed higher, closed higher, closed higher, even though it fought, closed higher. So notice that I'll put dots on the close of every candle. So January, February, March was just barely higher. April, May, June, July, August, September, October, November, December. Then we ripped up into January 2018. That was the melt up into a volatility event. That was a 20% correction. Peak to trough, I think, was 20%. Um, that was down 11.75 up to fresh highs. And then there was a bigger correction and bigger correction. All this was, 2018, 19, 20, some 10, 15, 20% corrections, like just a big broadening pattern the entire time. So challenging environment, right? Is like 2017 felt easy for the passive trader, and they just dealt with a lot of indecision for several years after that. There is your 20% correction in 2018. So 12% up to fresh highs, down 20%, up to fresh highs, down 30%. Yikes. COVID was, yeah, 2020 right here. There's your peak to trough during COVID, high to low. Yeah, we still came out of that with all-time highs. So look, we keep going back to this. This is why I'm saying we can't be scared, right? We can't be nervous. We can't be scared. If you have cash available to trade, we will be fine. I think the only thing that would make me nervous is if I was fully invested right now in positions. Meaning, all right, if I wanted to, protect the downside, how many of you, we talked about this before, how many of you know what a collar trade is? Collar trade on owned positions. It's really um it's not it's not an income trade. What it is it's pure protection. Um, you can pull out some credits on these trades, so you can make money on a collar trade. But it's essentially I want to protect my downside. Yes, you'll have to manage that downside, but a collar trade is if you have own positions. Let's say, um, how many of you own at least 100 shares of something? And it depends on the stock because some collar trade positioning is better than others. But it's when you sell a call, at or above price, and you buy a put at or below price. So you have downside protection and you have uh, credit premium to finance the downside protection. Okay. Ideally, this costs $0, or you can actually receive a net credit. So if you want to play the protection game, okay, if you want to play the protection game, this isn't a bad way to do it. So how far out? I mean, if you want to set it, forget it. I'd go out 6 months, 12 months. If you could pull in an extra, well, I don't know. Let's just say this is on the SPY. If I SPY's trading at about to be 690 again. So if we're trading 690 SPY, I sell the 690 and I buy a 689. I buy a 688. I buy a 685. Give myself a little bit of cushion. Try to make this a net credit. Maybe I can receive a couple of bucks. Let me see if I did this on SPY, what it looks like. It's not live right now. We'll be live in a few minutes for the market. But if I went out to, let's just say I want to, forget about 2026 as far as like I'm so uncertain. I don't know what to do. I want to protect at least the downside of all my own positions. Go out to the end of the year, and let's go out to, let's say I could do a 690 by 680. Okay. Or, I mean, this isn't bad, right? I don't know if this is accurate, but that'd be a heck of a good trade. If we're within a couple of bucks here where I can sell the 690 call, buy a 685 put, at least I've got some real protection to the downside within a couple of dollars of current price, and I'm still pulling in about 1,700 bucks. That's not a big gain, obviously. Pull in like $1,700 out of a $69,000 position. You're guaranteeing 2.4% on the S&P, but you can also lower your cost basis. If we drop 10, 15, 20%, you ride the 685 down, you try to lower your cost basis as much as you can. And, within what's 2 to 3 points. I mean, within 2 to 3 points, let's say, I don't know, let's just say that the SPY goes down to 600. Okay. Well, that'd be an $85 move. I'm just trying to figure out where this roughly cost basis would be. If we drop to 600, you have 685 trading down to 600, which is an $85 move. There's at least $85 of value built into that put. Okay. So if we go down to 600 and this $38 put is now going to trade for at least 85 bucks, you lower your cost basis by almost $50. Is it perfect? Is it like, dollar for dollar all the way down to 600? Depends on the time that's left in the trade. If there's still time premium in this trade, you might have the 38.24 put or the 38.45 put, whatever the cost is. Maybe it's worth 90 bucks. Maybe it's worth $95. Maybe it's worth $100. Okay. So you would get, $75 of profit on this put, and the price is down 85 bucks or $87. So within about, let's say, 10 points of the actual move, you've taken your cost basis from, current break even at whatever it is, and you're not really sacrificing much profit. And even with the downside move, you can ride most of that down with it. You can kind of reset your cost basis, start selling some covered calls again, or just take the discount and then try to ride it back up to highs. So I would feel a lot better having some protection like this as opposed to no protection. And obviously, just adding puts to your strategy can be very, very difficult. If I have stocks that I own and I just add puts to them, that's an expensive way to increase your cost and lose money. If that put doesn't pay out, you're not going to see any better cost basis, right? At least with a collar trade, you can get some credit up front. So we'd still make 2.5%. If price is greater than 690, we could still make 2.5%. If price drops to 650 or 600, you can ride this down and hopefully, lower your cost basis right alongside it and then ride it back up. Okay. So just food for thought on that. That's one of my favorite ways to, have some income. I typically do this out like 6 to 12 months on some of my big own positions, campaign trades. Like if I have SPY, I have Qs, I like to put collar trades on if I'm worried about the downside. If I'm not really worried about the downside, I just sell covered calls because you'll chip away at the cost, generate some income week after week. You can always get back in. I think 2025 was a pretty good year to just do that. Once we got through April, May, June, July, August, September, October, I mean, we had a choppy last couple of months, but getting through, the bottom in April May, June, July. The market ripped obviously really aggressively. We had 40+% off the lows in April. But if you were just, taking a trade, selling calls, getting income, buying back into the SPY, selling calls, getting income. Um, Typically you can do that to outperform the S&P. You can generally get, 0.3% a week, 0.5% a week, something like that. Adds up to, you know, I don't know, somewhere between like 15 and 25% a year on just covered calls. But you have no downside protection on covered calls if the market shoots aggressively lower. You just have to keep kind of grinding against it. Okay. Venkat says, I've been doing that and still losing money on the puts as well as on the stock. Um, you've been doing a collar trade? I mean, you can be in a drawdown, but your put should be gaining in value. Depends on how far out you're going. I mean, obviously for my put here, if I did a 690 by 685, I'm pretty tight to price. I mean, that's a 46 delta put. So it's almost at the money. Where people get where people mess up a little bit is they try to go slightly higher, right? Like I can go up to a 700 call, go down to a 680 put. I get $1,200 or almost $1,300 of credit, but now I'm out of the money. It's a 44 delta here, but price has to drop a lot. And in 2025, we haven't dropped a ton. So anyway, it's still something you have to manage the downside. Here's kind of the story is this is a great option strategy for protection, but you have to manage the put side for profit in order to lower your cost, right? So let's do that math again, like I said, using that SPY example. So let's say we own SPY shares. If I went out to the December 2026 expiration, sell the 690 call, which again, I'm capping my upside at 690, but this is like, I think the market's going to fall, right? If that's your opinion, then this is a way to generate some income, but also have downside protection. You buy the 685 put and you still get about $17.80 credit. Okay. So if the SPY rallies greater than, 725 by end of year, we're capped at 690. So what are the options there? Well, we can roll December 2026 to maybe January 2027. Maybe. I wouldn't want to roll out too far, but I would say if I rolled it out like a month and maybe January 2027 and up to like 695 or 700, maybe we can turn that into like a bigger gain to the upside. Even though prices at 720, 725, we can maybe squeak out another couple of dollars. We might have to roll that for a debit, by the way, which is never fun. But anyway, we could do a roll if we needed to, or we're capped at 690. Okay. If the SPY falls to 600, we would consider managing the put side for profit. So around a 38.45 debit for the long put, and we'll say 688 price to 600 price equals $88 of real value. That's our intrinsic value for the options vocabulary. Is intrinsic is like the real value of the option, because from 688 down to 600, there's $88 of value baked into that, right? And then we'd have potentially more with time premium. So we ride, let's say a 38.45 debit to, I don't know, let's say it gets up to like a $90 price. $90 credit equals about a $52 improvement on our costs. So if our break even is around, or current price is 688, but we can lower our cost basis to 630. That's not bad. 635. I mean, we're not all the way down, but would you rather be down 90 points, or would you rather be down 30 points? If I was down 30 points out of a $690 instrument, I'm down 4% versus, oops, the 90 out of 690 versus 13. Is that right? 30 out of 690? Yeah, 4% versus 13%. That's a big improvement, right? Much more tolerable drawdown. So it's just easier to repair that trade if we're in trouble. So anyway, just thoughts. Let's look at what we have for the day. I don't love this. 6898 up on the day. I don't know where this thing came from, but this is not looking good at all. 6835. Let me check some gamma here. So let's go dynamic. Okay. That's probably part of the difficulty there, Venkat, is going out a month only. If I'm doing a collar trade, I would be going out probably 3 to 6 months, if not more. For hedges, is like I don't like to hedge every month. That's expensive, and usually hedges don't pay out. So 3 months, 6 months, 12 months, you pay way, way less for time premium on that. You can pull in more credit, obviously. That's a bit of an easier way to kind of finance your protection. All right, this is interesting. So this is what I'm showing for a 0 day today. So we had 69.25, 69. This is pre-market SPX. So we're obviously opening up live right now. We're above that positive negative gamma. Okay, so that's encouraging. The stickiest level right now live is 6,900. The 69.25 is starting to fill back up, which hopefully is encouraging to see this market, try to get back to highs again. Let me check on a couple other levels. Let's go out a little bit further here. So I'll take my 0 DTE. I will go day trading. So this should go out to about anywhere between 0 and 4, all the flows that come in for 0 to 4. Okay, so going out a little bit longer, we're starting to see here this 68.75 is a pretty significant strike to the downside. And I'm going to go out swing trade here, which, I mean, for us, we don't really have a swing trade window. That trade I took out, we did the broken wing butterflies that get us to Monday the 5th. You go edit study. So if I go swing, this should be out like up to 2 weeks. Let's see where the gamma is for 2 weeks. Okay. So going out a week or so, biggest gamma level is sitting around 68.75. I see. Let's see here. Trying to hedge Palantir. Yeah. I mean, if you went out 3 to 6 months on Palantir, that's a little bit easier than going month by month. Month by month, you're going to end up, I'd say, having difficulty managing the put side, unless it was just a massive flush. It's like it's forcing you to be really active on protecting when it's like, I mean, if Palantir's down, what's your protection level? Is there a price where, I mean, take a fib from I'm talking like huge low to a huge high. I mean, if I had a collar trade on Palantir, it's covered up here, and if price were to fall, let's say to the 50%, that's kind of what I'm looking at. It's like this big, massive protection. Could Palantir fall to be uglier? Maybe. But also, if you took profit on the put side, you can also take a new collar trade. So again, like you're going to sacrifice some upside, but it is mostly for downside protection. Okay. All right. So I'm just going to write this one down. 68.75 seems to be a important gamma level that's popping up on the radar. Now let's go back to zero DTE. Okay. So sticky around this 6,900, 6,895. That's interesting that I see a 6875 on dynamic trend, but there is a 6835. That's for this is only zero DT. That's a big level. Let me go to live get live web app right here. So today 6890, 6835. That's a big difference. You go out to Friday, 6875. Okay, Friday's got 6875. Go out to the 5th. And 75. Okay. Well, let's have a look at something here. Let's go SPX. Looking about a 21 on the day so far, 21 plus or minus from current price. So could we go down to 70, 75? Yes. Could we go up to 10, 15? Sure. Looks like the market's rolling over a little bit. It's maybe check on a couple of spots here. 50% ATR is around 68.80. We're looking like a plus minus 21 since the open. So we opened up around, we are in the first 5 minutes here. So the first 5 minutes, 98, we're down 7 points at the open so far. And we'll see if this evolves into, does this side fill up a little bit more for negative flows? Do we end up pivoting it all into the upside? Chart alarm going off, 68.90 crossing. Okay. All right, let's have a look. So plus minus 21, see if the VIX is going up a little bit. It is kind of going up. Are we going to break these recent highs at 15? Okay. Well, we will find out how this all works out. So that little Santa rally trade that we took, we want price to be at 68.95, 6,900 if possible. If we're going to fall to fill this gap, I mean, I don't know. I don't think we're going to fall that far today. That'd be a pretty nasty move if we did today. But this is a very large transition zone where it's like we're in negative gamma right now. Okay. If this is a, give it back the end of the year, maybe it's a heavy day of profit taking. I'm not really sure. I mean, what's the Mag 7 going to tell us? If you want to see like what's the overall flow, could be anytime you see like 60+% of the S&P doing something, not Mag 7. You've got, wait. You've got a 5X Mag 7. Are you kidding me? When did this get approved? I thought they squashed those 5X leverage instruments. Yikes. I would never trade that. Here's Mags. Okay. We had a big gap lower yesterday on Mags. Look at that thing. So Mags is down 1.5%. No, it's not something I mean, I don't really trade it. It was when I participated in Mags this year, it was after the correction. We were down here towards this low in 2024. So this corrected like 30%. There's a 33% correction. And we were down to the same levels where it's like the S&P looked like a bottom. We saw like it was the S5FI. That's the 50-day moving average market breadth indicator. We were already at like multi-year lows, and it was just a good timing indicator. So I bought Mags around $39, $39.25. And I wrote it along with the SPY, the Qs that I bought shares on, wrote it back up to that level. So that was buy the stock. It's a pretty good return on investment. Almost $20 a share, which percentage wise is pretty decent. $20 a share on a $40 instrument. It's pretty decent, like 50% gain. But options are a little bit, yeah, it's not an expensive instrument. So the options, you're not going to get like juicy premiums or anything for it. Okay. If mags is going to go lower, it is going to be very difficult for the market to be up. So I want to check on something really quickly here with our end of year stuff. So SPX, Santa Rally. We have one Santa Rally trade filled. That is a 68.95 break even. And the one is still pending, which is around the 68.50 zone. So that'd be a break even of around 68.45. Anything above 45.50 is a profit trap. It's trade for 70 cents right now. I'll keep an eye on this one because if this one offers like $1.25 or $1.50, I wouldn't mind taking the trade to try to wash this one. So I'll keep an eye on this one through Friday. So we have trading today, no markets tomorrow, Friday to see like where prices are at. Write down a couple big levels, 68.75, potentially a 68.35. That's a gap fill, and there's a gamma level. Okay, 68.35 is right at that gap fill. What would be that correction? That'd be a disappointing Santa rally to see the market down 1.6% and essentially give back the holiday trade. The holiday trade through Christmas, this was right before Christmas. Market rallied, finished December on a positive note. And if we give it all back and hit 68.35, that would suck. Just we're not sustaining these gains, right? Okay, David says, is that for today? Yeah, that's not a bad trade for today. Let me see. Let me zoom in here. For today, I mean, we don't know, but market opened up. You did yeah, that's pretty safe. Let me see if I can get something on a broken wing since it's early in the day. I don't mind looking at some sell trades today. Could I get a 20, 25, 35? And that's a broken wing butterfly on the call side, only giving me 10 cents, a call spread. You went 5 wide and got 60 cents. That's pretty good, man. Just on the call side. That's pretty good. And when did you put that trade in? Okay, so that trade is out. Okay, that's a trade out to Friday then. I was like, that seems a lot of premium. One of the put spreads from last week. Yeah, the 7 day, right? No. Yeah, hey, my platform was a different day. Okay, gotcha. Okay, let's keep an eye on these. So I don't love this. I don't see any 68.75 here. I do see, we're starting to notice again, and this is all subject to change, but look at all this. This is showing us like the market's rolling into like negative gamma right now. We're kind of in an interesting window here for the next like 1 or 2 weeks. Is this market going to give back some pretty intense holiday gains? Maybe. So we'll see if it gets nasty, nasty. But 68.75 is a big strike today and into Monday, Friday. So what is lighting up today? Well, we still have 6,900, probably the largest gamma of the day. But is this the call wall, which is we're not going to get above 6,900? Looks like the market's rolling over a little bit. So could I get in? Let's just look at the numbers here. So this, we might see the VIX going higher today, and if that implied volatility increases, then you might see like a, plus or minus that stays relatively elevated. Um, if I think we're in like a bit of a down slump today and the market's not going to come back, I mean, we could do a 15 delta. You can get 70 cents today for a 69.15 by 20. If price is going to struggle, um, maybe I'll flip this around. So 15 by 20, that's a 15 delta, or go 11 delta and go 11 delta. Like this trade for a buck isn't too bad. This trade for, if I put this in as broken wings, it wouldn't be bad either. Just so I have a profit trap opportunity. So this would be risking 420 to make 80, which for the day should be fine. But if I did 40, 35 here, that's offering 20 cents. If this was offering like 50 cents or a dollar, I would take this trade. I'm gonna put this trade in for a buck. Let's go 45, 35, 20. Let's see. What do I want that trade? I'm going to see if I can get this trade in for a dollar. Okay. And then a 10, 20, 25, 35. Try to get this one for a dollar. Right. So if I just did a daily profit play today, 69, 15, 20. So sell the 69, 15, 69, 20. That'd be my bear call spread. That's a 14 delta. If you want to go slightly lower delta, 20 and 25. Then on the put side, 35 and 30. This is offering 75 cents out of a $5 spread. If this trades up for a dollar, that's not a bad trade. It's not a bad trade. Yes, it's more risk than reward. If it filled for a dollar, we've taken a lot of these trades where we get a dollar and we, you know, take 75 cents of it, 70 cents of it, 80 cents of it. It's a pretty safe trade. Giving ourselves some room, plus or minus 22, 23. We are seeing an increase in the VIX, but I'm also going about 50 points on the put side and about 35 to 40 points on the call side. So hopefully price will stay, inside this range. And let me just make sure this is outside of our 50% ATRs. 69.11 is my 50% ATR to the upside. And we would be going to the 100 plus percent ATR to the downside. I'm going to see if this will fill for a buck. Okay. So I'm going to put in a daily profit play for a dollar, see if it gets filled. Trading for 70 cents right now, 75 cents right now. All right. So daily profit play. Oh, I had this. Oh, I'll cancel that message. This is a 10 delta sell strike. It filled for $1. Looking for $1 credit, $4 risk. And I'll protect at 50 debit or lower. Okay, new trade is in. Yep. So we already had a bit of a push to the downside. We're already at the 50%. That's fine. So either the market is going to be bouncing off of this 50%, or if it goes through it, then these levels are lighting up a little bit more. There's 100% ATR right around this 68, 65 zone. But if we, bounce out the 50, come back up to neutral at 68.95 or 6900, then, we're still looking at this as kind of the dominating gamma for the day, which is around 6900. So we could go down first, come right back up, and it's just a big, like, choppy day. Not much happens on New Year's, right? We'll see. So trade is in. I'm going to see if I can construct a little bit of a broken wing out of this too. So that's a buy. So if I buy, sell, buy, this would be a tough one to get filled for 0 DT. So that would be buy. Make sure I'm doing this right. So this is a sell, buy. So we're starting a broken wing butterfly. That would be a buy, sell, buy. So that's a 25. And that delta starts around 8. If I did this one, I would be buy, sell, so buy, sell, buy there. All right. So I can throw in a couple broken wings at those like lower deltas. So can this get filled for $1 credit? Maybe. This one, could this get filled for $1 credit? So our Santa Rally trade has a profit trap at 6,900. 6,905 is pin. 6,900 is $500 profit trap. 68.95 is break even. Well, I guess 68.94 is our break even. So we want to see this price get back above 6,900 by Monday. So if we have a slide today, be curious to see what the flow looks like on Friday the 2nd. And then if there's any type of recovery either on Friday the 2nd or Monday the 5th. And then the second trade is pending for the 68.55 area as well. Okay, so keep an eye on markets today. A little bit of red in the portfolio. Mag's down a little bit. Let me set a couple chart alarms. All right, so chart alarm set at 68.50. I'll set another one at 68.35. That was that pretty large gamma level that we saw. So 50, 35. If we get a trade down here, that would be our, I mean, I guess you can call it the Santa Rally. Santa Rally trade 2 would be filled down here. And then we want to see a price will get back above 6,900. So let me set a chart alarm at 6,900. And see if we come back to that. Okay. Which one's coming up as debit there, AJ? So I have a pending order for daily profit plays trading for 75 cents credit. I want $1. So if it doesn't fill, Okay, fine. But I'm putting in like 10 delta strikes. It's offering me 70 cents. I'm asking for a dollar, which means price can drift a little bit more directionally to get me filled for a buck. If it doesn't fill today, that's fine. It's, I'd rather take the trade where I want it to be. I'd rather get the credit that I want versus settling for, 70 cents and taking out potentially a little bit more risk. Okay, let me check one thing here. Okay, these are out to mid-January. Um, wow. 240, 155. This makes for an interesting trade. 240 by 155 by 140. This trade's up 5 grand right now. You see something. That's a pretty good hedge. We go. Okay. So 240, 230. Oh, what a crappy. Oh my gosh. All right, never mind. So silly little broker. This was a 240. Change the color here. So this trade was a 240 long put and a 230 sell put. So that's a 10 wide profit trap. And then another sell at 155 and a sell at 140. So the net credit was $3.90 credit. So the goal was I get 390 on the trade, potentially up to another $1,000. And what they did is they assigned me on this 230 sell put. I was assigned 100 shares. So I own more shares at the 230, but I'm long at 240. So let me make sure I do the math on this correctly because it's showing them up $5,200. I do have a long put at 240. The 230 was assigned and price has gone lower. So I mean, this should be good to like kind of lock in my profit. What I want to make sure is if I close this trade, I'm actually closing it for a net profit. So that would be, let me do the math here. If I take the trade, 155 and 140 be my assignment prices, divided by 2. So 147, pulled in 390. So 147.50 out of $1.95. So minus $1.95. So I'd own shares of MicroStrategy at 145. That should be a pretty easy repair. As long as we stay below 230, I still have that $1,000 profit trap. So this is a little misleading to think that I've got $5,200 of profit when really I was assigned another 100 shares that I really don't want. So I want to see price stay below 230 to guarantee this this profit trap. And I need to be protecting and covering at a 145 break even, which I'm happy to do. So let's see. This doesn't have any additional assignment, but I have to keep an eye on that one. So let's write this one down. Couple updates here. Fun, fun, fun. $240 by $230. $230 sell put signed. $155 and $140. If signed. Break even is $145.55. Which will repair that quickly. Okay. If price stays below 230, that's a $10 profit trap. All right. So technically the break even would be, I've got to do the math on this. So 155 and 140 is a 147.50. Now, because I have a $10 profit trap, I can take another $5 off of this and another $1.90. So my break even is actually 140.60. And I'll see if I can, if I need to repair this. I mean, my break even is 140. If we're trading at 150, 155, I can just do like an at the money call for a week and try to grab a couple of bucks out of this one. I won't really worry about this trade until the 16th expiration to see what this trade ultimately results in. But if I went out, let's say a week, and I sell something at the money, it's like I should be able to repair that trade for like a $400 to $600 winner. And if it stays above 150 or 155, then there's no assignment on the put side, and it's just a nice little win of $1,390. So anyway, just updated that spreadsheet. I knew MicroStrategy is something I got to pay attention to these next like 30 days. Our trades for waterfall income still looking pretty good. Here is our waterfall income trades. So almost in full profit, full profit, full profit, full profit. All these are trading for like 90+%. This one has gone down to 70%. This one's up 73%. This one's out the furthest. But 1, 2, 3, 4, 5, all looking good for full profit within the next 16 to 30 days. Our longest trade that I'm watching here is 51 days out, with about a 15 to 16% room for error from the previous all-time highs just in the last week or so. So all looking pretty good for some income. Plus, they all have profit traps of $1,000. So we could have, nice income of about $400, or a couple of profit traps or a profit trap. If we have a nasty spill and the market's down like 10, 12, 13%, we've got profit trap potential here that could give us a few hundred extra bucks, a couple thousand extra bucks, actually. Okay. And we'll see how this Santa rally trap deal plays out with 69.05. If we get filled at the 68.55 one or 68.65, that's okay. I want to see how that plays out. If that profit trap is going to pay us, then we net profit on the two trades. Let's see your waterfall, the last two fill. Let me check. I don't think so. Not yet. Let me go working orders. This one is still pending. And then, so we did one for SPX that's still pending. And then we did one on Monday this week for XSP, and that is still pending. So those two orders, the top of the spreadsheet on waterfall, those are still two pending orders, David. Or I'm sorry, Chicago's asking that question. David says, "There's broken wing butterfly today." Yes, I did add a broken wing. I'll give you those for daily profit play. I'm not going to the VIX high and low. I'll probably add that in addition. Let me recenter this thing. So let me go VIX box here from the open. We closed yesterday. $68.96 close. Let me zoom in on my chart here. $68.96. So I'm going to center the daily profit indicator on $68.96. There's my VIX box. 30. Yeah, I do kind of like that. Not typical, no. But for the trades that I'm in for strategy two, it's typical. Like strategy two, I want price to come to us. You know what I've been doing for strategy two is I'm giving ourselves like 15% room for error on strategy two. We discussed that pretty thoroughly in the class on Monday together. So I want that to basically set up the risk reward that I'm comfortable with, and I want that profit trap. So I'm asking to get filled for 50 cents or $1 for income, but also have a profit trap in there for like $1,000. So I'm gonna let price come to us, which means if the market falls, that trade gets filled, but we still have like a 15% buffer. Okay. All right, Nova, I'll take a look at silver in a second. So, yep, broken wings. I'm adding two broken wing butterfly defense trades today. They are pending orders. So I'll see if I can find those really quickly. $12/31 expiration. Put side. Okay, let's type this up for daily profit Line members. Okay, these are pending orders, defense trades. They're not filled, but if they get filled, then at least the profit trap and the pin price is where I want them to be. That pin price would be right around the VIX box low, which is pretty good. That usually does a good job of calling bottoms on the day if we need it. And then the upside, it's not a VIX box, but because we've already started leaking lower, I don't think we're going to have a big fat rally to the upside today. So I'm just going to leave those in at like 7. They're like 7, 8 deltas. The put side is going to be testing the VIX box, and the upside would have to be a pretty big move back up to recent highs and maybe a gap fill. So even if we fill this gap, or we come down and find that 68.35 gamma, that's my defense trade. And obviously I'm hoping that, price for our daily profit, if we get filled at $1, it still just pays us on the day. All right. And here's what the day looks like. So gamma pivot 68.95. We are below that. So we're starting to, have mostly negative gamma flows on the day. Negative gamma, like I said yesterday, negative gamma means that there's more selling calls and buying puts. So buying puts, selling calls, that's kind of looking for prices to go down because you get, unlimited profit potential on the long put side, and then selling calls because you think the market's going to make lower highs. So for a negative gamma, we are expecting prices primarily to fall. If we get back above 68.95, then we go back into positive gamma, and that flips the option flows to selling puts and buying calls because you have unlimited profit potential to the upside, and you're looking to put in a floor and see if this will turn into, that slow stair step type look to the market. So we're a little bit on our heels this morning as far as, down softly, just in a negative gamma, but we've hit the 50% ATR. Hopefully, we're not going too much lower than that. Okay, if we hit the 100% ATR, we probably will see that daily profit play fill, but our strike is at 35 and 30. So what was trading for about 70 to 75 cents is now trading for 50 cents. We'd have to see price move another, 20 points lower. So probably 20 to 30 points lower for us to get filled. So, I mean, personally, it's like, I'd rather not fill. I'd rather see if we can squeak out a Santa rally trap here back around the 6,900 handle, or hit, the two like Santa rally trap trades and have one around that 68.50 zone and see if that level can hold in by Friday and Monday. It's an overlap, but it's not a conflicting contract. Like I have so 68.35, 68.30, and my butterfly is a let's see here. $40 and $30. Wait, did I do that? On the put side, is that incorrect? No. So the call side's fine. Call side 25, 30, and 40. 25 is a buy. That's fine. So there's no conflict there. Put side 30. I hate it when it does this. So it's supposed to be a. Sometimes the activity log here shows the wrong contract sizes. So this is my daily profit play. This is my my broken wing butterfly call side. I buy the 25, sell the 30. On the call side, I am selling the 20, buying the 25, buying the 25 here. That's an overlap, but it's not a conflict because I'm buying the 25 here, buying the 25 here. I can get both those trades filled. I just have to separate them out. Okay. And then on the put side, what trade did I just cancel? I'm looking for the 30, 25, and 15. Put side 30. So this is a sell and buy. So if I buy the 30, sell the 25, buy the 15, this is a overlap contract, but it's not a conflict. Okay, see if this one gets filled for $1. There. So it's correct. It just, see how it's put it in incorrectly? Gosh darn it. I'm just going to try it again just for my own peace of mind. So buy, sell, buy. Okay, so this is a correct broken wing butterfly, a 1-2-1. 1, 2, 1. And I want this to fill for $1 credit. And for some reason in the activity section here, it pops up as a 1-1-1, which is not correct. It actually is a proper like broken wing structure. So the overlap is the 30. But it's a buy 30 and then a buy 30. So if they get filled, I'll just have to keep the contracts separated or in mind, but I know what trades I'm in as far as like managing them. If you want to move the broken wings further away, then move all the strikes. right? So if you have your put side daily profit play right here at 35 and 30, then do a 25 and 20, right? If this is your put side for daily profit play, then do a 25 by 20 by 10, and you don't have to worry about the overlap, right? Now you have some, it's like almost like you have immediate defense. If you have your iron or your daily profit play, and then you have your broken wing right here, that gives you an extra, you know, like 10 to 15 points of forgiveness and some defense if you don't want the strikes to overlap. Okay. Same thing here on the call side. If you have the call side would be 20 and 25. So if you have the 20 and 25 and you don't want them to overlap, then just buy the 30. Buy the 30, 35, 45. Rob, they're posted for members in Daily Profit Play Telegram. So I've got the 20 by 25 call. And then I'm doing the 25, 25, 30, 40 broken wing butterfly. So the reality is none of these have filled, by the way. So I have a daily profit play that's still pending. I have broken wing butterflies that are still pending. Like these three positions, none have been filled yet. So how do they get filled? Well, if price is going to fall, let's say down here towards 68, 70 or 68, 65, that might be enough to get us filled on the daily profit play. Although our strikes are still way down here, right? There might be enough direction to get us filled. So we'll see. Okay. Is everybody clear on that? Again, those defense trades, if you don't want them to overlap, then move the strikes higher on the call side and lower on the put side for the broken wing butterfly. I'm going to overlap the buy strikes, but that's like I know how to separate that out in my broker platform and I can manage that, but I want my defense kind of right there at the iron condor level. So the summary is this: here is a daily profit play, okay, and then for upside defense, there's a broken wing butterfly with all calls, and then my downside defense is an iron or a for some reason iron butterflies in the mind. Broken wing butterfly with a 1, 2, 1. So the 30, 25, and 15. All right. And like I said, none have been filled yet. So they're all still pending orders. The day might continue to go and nothing fills. So we have these trades sitting pending orders, but if nothing fills, then, no harm, no foul. Okay. All right. Yep, I know. I see that penny. So we are sliding below the 50% ATR. I mean, it just seems like some profit taking today, honestly. Like we're below the gamma pivot point. If it's some profit taking, we're also being led by Mag 7. So just take a look at the structure. I mean, where are we potentially going? We have this level right here for a potential gap fill, and we have this level for a potential gap fill. So if the market is trying to fall first, find some efficiency in here, and then hopefully use that as some near-term support. We'll see how the dust settles. Right. So, I mean, if we bounce off of the ATRs, okay, fine. Here's my ATR look on dynamic trend. We're right at the 50% right now. Could we fall a little bit lower? Sure. Write this number down, 68.65. If we hit 68.65, that's 100% ATR. And, again, it's rare for prices just to fall all day. So if we hit the 50 and it bounces, or we hit the 100 and it bounces, I mean, it seems to be pretty important to see that there is some, built-in support on some of these gamma levels. And also the largest gamma of the day is still 6,900. So even though we are moving to the downside, is the market able to get back up here for the day and kind of finish flat? We opened up right here. Do we finish flat on the day? It's very possible, right? But I don't know. I'm just trying to make a trade that hopefully gets me profit today. And the trades that we placed are pretty far out of the way. Has VIX made a crazy run to the upside? Not really. I'll set a 15 VIX and a 16 VIX and just kind of keep an eye on things, because that is more challenging to call the bottom. If the VIX is going aggressively higher, it's difficult to call the bottom. So I'll just keep an eye on that today. All right. So we are down on mags a little bit. Let's see the heat map, and then we'll talk gold and silver for a moment. So this is it's a pretty broad market slide. 62% of stocks declining this morning. A lot of like dark red in here, which is not aggressively bearish, but we just have a lot of stocks that are softer today. Okay. So this like slightly, dark hue is less than 1%. So a lot of stocks are just down across the board, like a softer open, profit taking, maybe. Day is not done. Maybe it gets worse, and maybe it gets into like brighter red, which means we got some bigger slides today, like Micron's down 2%. But this is 1.1, this is 0.61, 0.32, 0.08. So just a softer overall market at, 62% of the market is in softness, like 0 to 1% down. The day isn't done. We'll see where the day ends up pushing or sliding further. So we'll watch that for the final year of trading. No trading tomorrow, no live session tomorrow because of New Year's Day. Markets are closed. Bonds closed today at 2 p.m. Eastern time. Markets are open until closing bell at 4 p.m. Let's talk some currencies for a moment, and then we'll talk gold and silver. So dollar stronger, New Zealand is weaker. That's just a glance today. Not a ton of volatility. Kiwi's a little bit softer. Let's talk gold and silver. Continue with decline. How many of you have heard me talk about this 200-day moving average on gold for like the last several months? So this is why I've been cautious on buying gold at these highs. Okay, because we have a bar count that is up to like 560 bars. That is a lot. The last time this tested the 200-day moving average was all the way back to October 23rd, 2023, and we're at like 560 bars, 68 bars, almost 570. The last time we did this to have that type of tremendous run to the upside was 2009 to 2011, and we hit 600 bars and we absolutely plummeted like 20 to 30%. So it would have been a pullback and correction into this area. I think it's right in here around like this May '09. And we went, we just crept over 600 bars, and look what happened like right around that 600 handle. So as we hit 600 bars, right on this peak, a little double top overstretched, got really far away from the moving average. It was over 20% extended, and at 590 to 600 bars, it ended up correcting very quickly about 20%, and for there proceeded to stay sideways for years. So, I don't know. Gold and silver, very interesting dynamics this year. Everyone's trying to say like this is the debasement trade, this is the end of the US dollar. It's a story. I don't know if it's going to be true. I think that people are getting really excited about gold and silver. I think they're getting overly excited. I think they're getting overly frothy. I think what this does is this adds a lot of mania. This adds a lot of FOMO, and going to current prices. Okay, yes, we've had an incredible run. It's been a great uptrend for the last couple of years. We bottomed out in. So here's a COVID play. It's like silver or gold and silver were sideways during COVID. 2022 was really the big flip here. It's like we bottomed out in 2022. It has been just a nonstop trend for the last 3 years, but gold has done pretty darn well. It's up 170%. Peaked around 180 these last couple of years with that bottom in 2022. Now, I'll go back to the bar count stuff. We were over. Here's a 23% stretch away from the 200-day moving average. I wasn't surprised we had a correction. Now, that correction did not even get to the 50-day moving average. We hit a new all-time high again, but our percentage is about 19.3%. So not only do we have a very high bar count of 568 bars, we still are sitting around 19 to 20% away from the 200-day moving average. So look, I don't care if gold can like just try to get new highs. This to me is going to be some type of rising wedge. So if we're lucky and traders want a chance to take some profit, I think that's going to be the time to do it. Right? If you're protecting positions, downside would be, pulling back into this area where this thing started, pulling back into that 200-day moving average, maybe even pulling back to previous all-time highs right in here. But to me, this is level 1, level 2, level 3 to be positioning for more longs. I don't mind getting long. Okay. In fact, I want to get long gold, but I just don't want to buy gold at highs. So I don't know what this does, but having a big single day sell off is possibly enough structure to put in a bit of a near term top. And if this is high to low, chop around here, if it just starts leaking lower and it breaks this structure, then off we go. We'll correct. We'll find some moving averages. I am waiting with pending orders to buy some more gold. If it stalls here and goes right back up to the highs, okay, fine. Draw a trend line, connect the dots. Once this thing starts to roll over, we'll have a correction. So that's my outlook on gold. We'll hit this 200-day moving average. I'm almost like I'm trying to be disciplined here and almost refuse to buy gold until we have some pullbacks into my moving averages. Just because the bar count is so high, I think we'll hit it. Okay, let's go to silver. Silver, extremely noisy. We had a single day sell off of like 15%. It wasn't surprising to see like a very aggressive bump to the upside. Yesterday, silver's up like 8%, but it's not enough to overtake the highs. Go down to a smaller time frame. Okay, here's a 15-minute chart. Even go to like a 1-hour chart. Just get some structure on this. Here's what I could see from silver. If we're putting in a top, high, low, let's say we consolidate here. To me, this is going to slide lower. I could be wrong, but this is why I'm not in a hurry to buy silver. There will be plenty of opportunity to buy dips on silver. I wouldn't be surprised if silver, after a 180% move, has a 30, 40, 50% correction. That might be painful for everyone that's buying the highs here, but if you're patient, it's like you'll just get levels that you want a dollar cost average into. So I'm looking at this potential structure where if we have a sell off, this sets up for some type of flat pattern, and then the market falls. Measure symmetry, look at a little fib. What's a simple correction measure? If we go high to low, we could get to like $62 pretty easily on just a simple symmetry correction. We could possibly get all the way down to $50 again, which were previous all-time highs. So I would just be watching those levels. So I think patience will be a good thing. I hope, at least, because the hardest trade on silver is going to be it just won't stop going up. That's the hardest trade, which makes me even more nervous that this ends up giving all of it back. If the timeline of, hey, look, 10 years from now, where's silver going to be? Well, I'm hoping in 10 years, silver's at $150 to $200, maybe more, right? If gold's at 5 or 6,000, maybe more. But in the next 3 to 6 months, I can't look at a chart that's gone straight up and think that it's going to continue to go straight up without having some type of monumental crash. So it's had an incredible run. It's up 80% since October. And it's up 160, 70, 80% for the year. Like, it's crazy how awesome silver's been. But that doesn't mean it continues to do that without some ugliness ahead. They've raised margin on silver futures. Yep. I actually warned about that over the weekend. That video that I posted on Telegram, I said if they start playing around with margins, that's the crappy part. Is there is in the background here, there's a lot of potential manipulation that would happen on the regulatory side. If the CME or COMEX futures will trade margins on this to make it more expensive to trade, that is going to squash a lot of traders. So just like I said, just be careful. Future side, be careful. I trade a lot of SI for futures, but not now. I want to see like a decent correction before I start throwing in futures trades. And then SLV, I just have dollar cost averaging in. So the way I participated is I bought shares of SLV here. And I also bought in, this is for Project Options Edge, I bought in CEF on this pullback. And I bought in PHYS on this pullback. Okay, so we've had a nice little run on some of those to kind of get back in, because I had like a 3-year bull position that I closed out. So getting on this first dip, that's like my toes in the water again. I've got some exposure, but I'm not jumping back in like I've got to establish a full position on silver again. No, I don't. I'm waiting. I'm going to be a bit patient. Okay, industrial demand for silver is astronomical. Yeah, I know it is, because it's now not only industrial, but it's considered strategic. Silver has been used, is being used a lot for the AI build out. But you know what? Other stuff is too. This is one stock that I'm trading. I actually put in some positions this week on Alcoa. I'll tell you what I'm doing here. So I've been in this trade since the lows of around $25. I had 2 positions pending on Alcoa, which was I bought at 25 and I had a pending order down here at 10. Okay, this is aluminum, which doesn't seem exciting to anybody, but aluminum is like also in high demand. It's heavy in solar, it's heavy in AI, and it's cheap. So anyway, structure-wise, we had this nice big move that broke above these recent resistance levels. And so now what I'm doing is I'm still riding my shares at 25, but I bought more shares around 50. Okay. So I'm adding to this. I think that Alcoa can get up to, there's a big inefficiency up here between around $70 and $80. So that's my price target 1. And then I'm looking to get back to these highs around price target 2. Okay, because this initial trade was like this was an inflation value trade in COVID in 2021 that then just was completely reset. So this is now like an AI type trade where this is the physical side of AI, not the software side of AI. This is the physical build out of AI. So I have a $50 buy, and if you want to just buy the market, this is about dollar cost averaging. So I put in, for my smaller accounts, I put in $1,000 here. And if we get a pullback, I'm putting another $1,000 here. And then I've got a 50% zone around $35 right in here. There's another $1,000 there. And then at the lows, At 25 again, another $1,000 there. So that's on my small accounts, and then for my larger accounts, I've done anywhere between $2,000 to $4,000 per chunk. So let's just say it's two and two and two and two. But what's my plan for this stock? I want to see if this gets up to $65 to $75. I'll assess the profit. I can maybe start selling some calls up here if I want to like let it get called away. Or I let this thing run to 80 plus and I start trapping all my profit over $80. So if we're above 80, I'm taking profit. I don't care if this thing goes to 150. Like I'm just going to measure the move and take the profit at a nice level. And it's a good trade. So Alcoa's on the radar. Yep. It's aluminum. Aluminum. Yeah. And then I saw Lance talk about this. This is interesting. I've been trading CLF and X for the last like 5 years. Also like a pretty good value play. This is steel. So CLF, this one has not been nearly as good as X. This is United States Steel. Donna, you remember this from back in the day with Equities on Demand. We bought a lot of this. Look at this thing. We bought a lot of this in the single digits. We were trading like $10, $20 on X. It's now at $54. I let go a lot of this stock in the 40s when we were hanging on to this thing. Bought it low around $10 and rode this thing up into some highs. And it's as a steel maker, there was I think United States Steel and Nippon Steel were talking about a merger. It was like really noisy for a while, but still pretty good return on X. But CLF is kind of the cheaper of the two. And let me check here on Simply Wall Street and see that we've got some upside potential. So price to earnings, price to sales. I mean, that's what I don't love. It's like on paper, they're like, yeah, they're fairly valued. But this is where the stock market starts to park money in these like undervalued or kind of beat up like value plays where it's like, all right, growth and momentum is going to slow. Where do people put their money? Right now, I think if this AI trade is going to be alive and well and the AI narrative is alive and well in 2026, I don't think it's going to go into the software side. I don't think it's going to go. It's not necessarily going into the hyperscalers. Like Mag 7 is fine, but I would be very disappointed to park money in Mag 7 and see little to no gains. So I'd rather put it in places where it's like, what do we need to build out AI data centers? We need steel, we need copper, we need silver, we need aluminum, we need all this stuff. Commodities. We need a lot of commodities. The one good thing is oil prices have been suppressed, and that's kept inflation pretty low. But I think the physical demand of all this stuff is going to start showing up 2026, 2027. So again, the important thing is that the narrative remains firm. We have to have an optimistic narrative on AI, but we can switch from hyperscalers and software to the physical build out, and then that makes the commodity play look pretty good. Okay, UNG. Goddamn, this thing won't. I mean, to me, I want to get out of this thing. If we flare up to $20 again, I'll get out. I've got calls out to 2027. I just want to see if this thing will spike up to 20. I know that we could have this big run. I don't care. It's so hard to get a run on this and sustain it. So I'm long with like a $5 call. I'm trying to get out of this thing at like 20 to $25. So I exited half my position here. I'm still in it. I'm still hanging on to it to January 2027. If we get just one spike up, I've got chart alarm set, as you can see, like I'll close it. I don't know if this is going to run up. It might do absolutely nothing. So energy play. Yeah, but this is what concerns me. It depends on the slowdown. I mean, right now, oil prices at $58. We tapped 55 a couple of times here in 2025. I mean, I would say this, okay? I like long energy, but just on oil is really there's so much supply and demand manipulation in oil that it's hard to say like this is the bottom. So here's a measure move. High to low, lower high to lower low. I don't know what it's going to take for oil to break 55 and go down to $40, but to me as a measured move, I could see, this lower high, lower high, lower high, lower high, lower high. We're encouraging as much drilling and refining as possible. ultimately that's driving prices lower. But the lower we drive prices, the tighter the margins get, right? There's potential conflict when we're talking super, super low oil prices, and there's potential conflict when we're talking super high oil prices, right? And a lot of rigs go offline. Like nobody wants to drill and put in more refineries when oil's at $40 a barrel. So I mean, right now it's like it's critical that we hold this support to kind of keep things in equilibrium here, and everyone can kind of exist and be happy, and we're not having any wars flaring up. But from a measured move, high, low, lower, high, lower, low, I would buy lots of oil at 40, 35, and 30 if it was offered. Okay. If we came down to this level, I would say that to me is a pretty good energy play. It'd be at a solid discount. You can see that there's plenty of supply and demand here between like $55 and $65. So even if I got a discount at, $40 to $30, take it up for a nice little percentage gain, dollar gain, from let's say, 40 to 55, 40 to 60. That to me is a pretty safe trade. I don't want to trade the noise here. Okay. I had a good futures trade on oil. If it stayed above $50, that was a full profit for a couple $1,000s. That's about it right now. Energy sector as a whole, I like energy sector. I've got some XLE puts. We did it for Project Options Edge. So we got some ratio spreads on here. I'm willing to own some shares of the sector. As long as this isn't just heavily in oil and gas, it's like I want to see the energy sectors also in everything energy. The one thing that the U.S. needs right now, again, to keep this AI narrative going, we need as much energy as we can grab. The only problem is our energy is not nearly as efficient as other parts of the world, i.e. China. China spent a lot of time building out this infrastructure well ahead of this AI boom. So, I mean, they have like more energy output than like a third. Like I think what they're able to do is like they have like 1/3 more energy power than we do, and they're doing it at a much cheaper price. So like their scalability is dramatically better than ours. Does that mean I want to be long China? Not necessarily. I do like China for my reasons of the stocks are still like undervalued. I think there's good upside in China. I just think that nobody wants to trade them. Nobody likes to invest in China because think at any time it's like we can delist China stocks. Well, I mean, China likes Western money. And if Alibaba and Baidu and the large cap tech ETF FXI or KWeb, like there's some individual stocks that I've liked to trade the last few years in China. The index itself, or like if you're trading anything that's non-US, a lot of it is China exposure. So I've talked about SCHY in the past. I've talked about FXI. FXI is large cap China. SCHY is a Schwab dividend that's like a lot of Europe, a lot of Asia, a lot of India, Vietnam. It's like a 200 little company basket of ETFs all like over the world, just non-US. Okay. K-Web's done a lot. Yeah, I mean it's tech. Tech has taken a little bit of a backseat, right? I mean, I don't love like tech. I don't love tech. Tech's had a great run. Tech's had great momentum, but I feel like if we're rotating out of it, I don't want to be overly exposed to tech. Tech leads us and leads the bull markets, but when we see that tech and momentum is slowing, it tends to go into a little bit more, I'm going to say, defensives. One thing that's been underperforming, and this is a good sign of a bull market, by the way, consumer staples in the U.S. have been terrible. XLP. Okay, XLP is the sector for consumer staples. This sector sucks. Like year to date, I don't know if this is positive or negative, but it's been pretty bad. So this might be the only sector in the year that's still negative, right? And this isn't a bad thing. And some people look at this and say like, well, that's a good sign to buy this. Well, maybe, but in a healthy bull market, nobody cares about defensives, right? Nobody cares about consumer staples because there's no reason to have to flow into these if there's still other growth opportunities and the U.S. is still growing. But I think that the U.S. will be resilient and stable and fine, but I think that other parts of the world will outperform. If you saw the phrase American exceptionalism last year, I think that is deteriorating. And why is that? Because a lot of countries are looking at what they can do from a fiscal policy side. They're willing to spend money on themselves for the first time in a long time. So what does that mean? Well, that means that money, it's not necessarily like the money is leaving the US, but there's certainly some like bond uncertainty ahead with U.S. debt and U.S. debt holders. We've also allowed more foreign owners of treasuries in the U.S. And anyway, we've operated a deficit for many, many years, like we are having a constant crisis, and we spend money like it's a constant crisis. But other countries have basically had balanced budgets. So what are they doing now? They're just going to run a deficit, and that means that there's I mean ways to basically run their economies hot, which means whatever ETFs you can get your hands on that are non-US, they have a pretty good opportunity to outperform. Case in point, this year China was up 30%. Vietnam was up 80 to 90%. Africa was up 80 to 90%. Several country ETFs in Europe alone were up 40 to 60%. Are they super liquid and awesome to trade like, all the time? No, but as a trade that's just non-US exposure, it's a pretty good play. Okay. Why do I still like trade the US? Because it's super liquid and we have a resilient economy, and options make it easy. Like options, you're not going to get the type of option trades on non-US like you would in US stocks that are crazy liquid, like, trading the ETFs like the SPY and the Qs, trading your Mag 7s, trading your top, 50 to 100 stocks that are crazy liquid options. You're not going to get that anywhere else. So anyway, a lot of stuff going on for 2026. Okay. But sector wise, staples are still down. That's an encouraging sign for the bull market to still be a continuation. But take a look at your sectors as a whole. Okay. Like this is the communication services. I don't know if it's Google or Meta in this one, but one of those big Mag 7 stocks that's had good gains for the year. A lot of the weight is put into that. Nvidia is in one of these as well. XLY is consumer discretionary. Thanks to the top 10, 20% of the socioeconomic ladder still spending money. We're still sitting at near highs on discretionary spending. XLP, staples, like I said, one of the worst performing sectors of the year. Energy, pretty low volatility. The reason I like XLE as a diversifier is it's low beta. Okay, beta of 6, 7, and mostly non-correlated. Like if the S&P is down, energy typically isn't going with it. So unless oil leads the way for a recession, that could be maybe a trigger. But if oil's stable, then energy sector probably does well. And I own shares of XOM, which is ExxonMobil, and Chevron, CVX. I have shares of those. That's kind of an easy get a dividend, low volatility, non-correlated. Get a pretty easy either stable price, non-correlated price, and get a decent dividend. That's not too bad. XOP. This is oil and gas exploration. Again, maybe drives it lower, but at some point this becomes a bargain. If I see oil down to $40 a barrel, I'm buying oil. XLF, this has been a big talk of what will lead the sectors in 2026. Financials should be looking pretty good and pretty well positioned for gains in 2026. It's already had a great couple of years, but could it be more parking in banks? Getting some deregulations, taking off some of the bond exposure, eliminating a lot of the duration, like all these things are pro lending and pro banking activity that will hopefully bring in more profit. XLV, this is healthcare. I had a pretty good run in healthcare this year. I traded Johnson & Johnson, XLV, and got into some individual ones. Abbott Labs was one in particular. There's some biotech stuff, but it's been good. I think that this might be the next big beneficiary to AI. Hopefully, is that we start to see some major R&D, like research development. We start to see some major breakthroughs in, I don't know if it's weight loss, if it's cancer treatment, if it's whatever it is, these chronic diseases that have plagued our healthcare system for years and years and years. If AI can have some type of influence on making like treatments cheaper and more readily available, hopefully that would be good. Our healthcare system is an absolute joke. I mean, show me one person that like loves their insurance in the US. I mean, if you love it, it's because you have it and you've had to take advantage of it. Otherwise, like I swear, like every year I have to change insurance providers, and it's always like it's more expensive, more money out of pocket, higher deductibles. It's a nightmare. And anyway, I hate our healthcare system. But the trade-off is like, well, you could go live in Europe and you could pay 50% of your tax. I get it. Like everything else is high tax in Canada and Europe. It's like, I don't want that either, but there's got to be an in-between. Our healthcare costs have gone up. Our insurance prices continue to go higher. Everything's more expensive. We have a large, generation of people that will be needing more and more healthcare. We're living longer, and people aren't really sustain those retirements when you're retiring at 65 or 70 and you're living to 95 or 100. That's a lot of extra time where it's like healthcare gets very expensive. So anyway, I'll keep going. XLI Industrials looks great. Like I said, the physical side, the physical build out of AI, I think XLI, XLB, materials, like all this is pretty encouraging. Real estate, I'd stay out of that for right now until rates improve. Tech had a good run. I'm cautious of tech just because we have a rotation. Tech might feel it the most because you're going to take away a lot of that growth multiple. Utilities, boring, but not a bad one either. Okay, decent dividend, pretty low beta, non-correlated. So I like utilities quite a bit. After a split makes it even cheaper. This is a 2-for-1 split, so it went from $84, $85 to $42. Not too bad. Okay, so a little sector review there. Let's see. Agree XLV, dollar index. We'll take a look. Dollar index. Let's go back to the daily. So we're at 98.44. I mean, as long as the dollar stays below 100, that's the story that's just kind of feeding into like dollar weakness. I'm cautious of how bearish. This is the thing, is like all these outlooks that I'm looking at, it's like it's so bearish, it's so bullish that somewhere I feel like the truth is in the middle. Everyone's saying like the death of the dollar. Again, I've heard this crap for over 20 years. Look, if the dollar is going to get weaker, then the key level is, do we break this support? If we break the support and we head lower, that probably continues to fuel gold and silver in a big way. A weaker dollar, I do think, is risk appetite. So this is a risk on trade if the dollar gets weaker, but risk off if the dollar gets stronger. So I think, if the dollar is just going to be range bound, then everyone can call these big predictions, but they're not really giving us any direction. So watch for this like 96, 96.50 handle. If it bounces and we go right back to 100, I mean, that has some ramifications in what the overall equities market does. Okay. But in the near term, the dollar has been sliding. We are, putting some resistance in around that 200-day moving average. So the trend itself, as long as we're staying below these moving averages, we could still keep working our way lower until we find the support. That to me is the next big point. If we hit this level, are we bouncing or are we falling through? And I don't know yet. Okay. But we'll see. Right now, it's like, yeah, the dollar's weaker. And for risk appetite, you want to see a weaker dollar. Okay. All right. Okay, here's the deal. So I didn't realize how quickly we were going today. It's almost 11 o'clock, 10:50. So we're gonna play a session from yesterday. We did a session yesterday on waterfall income. We'll play that one. So look, it's the final day of the year. Markets are closed tomorrow. No live session tomorrow. We'll be back on Friday for daily profit plan. See if we can find a trade. I'm still watching the trades for today. Maybe they get filled, maybe they don't. We'll keep an eye on those. Waterfall income. We'll have class on Monday. I will sprinkle in a masterclass on both daily profit play, waterfall income the next couple of weeks. I think this is going to be my new course offered in early January, probably like the 10th or 11th. I'll start going live and you'll hear me talk about it. We'll talk about it in this session. I'll be doing some webinars with some other people in the company. I think we're calling it engineered options. I think that's what I saw yesterday. So income edge. I know grid is not the name. So I think income edge or engineered options. That's what I'm reading. So you'll see more about this in the first couple of weeks of January. I'm really excited about this. It's basically weekly, monthly income with the bonuses of you can supercharge this to go daily if you want to, or you can be more passive and go quarterly. Or my personal preference is I'm going to go weekly, monthly, quarterly, just because they're really easy trades to set and forget. Like you can set the trade up, it's risk defined, they get filled, let price do what price does best. But weekly is nice because we're staying with the current ebbs and flows of the market. I do have a dashboard that I'll check every single week. It's a service that I can run. Very low touch points for me outside of we're going to have a member Telegram. I can set these levels and alerts every single week, either end of day Friday or pre-market Monday, and we can just set trades in for monthlies and I'm going to go weeklies and monthlies. That's going to be my focus. Okay. So I'm excited about that service. We'll start talking about that more in the first couple of weeks of January. Project Options Edge, we have a lot more profits rolling into January. In fact, so for my managed accounts, I sent a message to all my clients this last week, and I said, look, I can sit here and we're sitting near all time highs for the year. We've had a pretty good year, pretty solid year. If I wait an extra 30 to 60 days and we take some of these expirations off in January, February, we have another 3 or 4% gains to then kind of go into like higher cash positions, nice profit chunk, and we kind of clean the slate like January, February 2026, and then I'm ready to start building positions back up. But I'm going to be invoicing clients January, February because we have so many positions that are sitting and still running, and I just want like that little extra pop of like 3 to 4% on Project Options Edge. So this has been a big way that I've managed some of my personal accounts, and we've got some pretty good profits that are still rolling in, looking pretty good for gains. Okay. David Rice says Income Edge covered under Diamond Club. It should be. If you're like an all access member, you should have access to the engineered options when it comes out. Yes. Yep.
Absolutely. That's why
Good
it pays
stuff.
to be Diamond right there.
Yep. So and I don't have like a link or slide for that, but if anybody wants to be like an all access member or Diamond Club member of my franchise, then you can contact our support team. They can walk you through that. Support at prosperitypub.com or give us a call 904-706-3537. I don't think anybody can go to my website and just buy everything. Like so you'll save a lot of money doing like Diamond Club all access versus a la carte purchases. So if you want to own like if you already own several of my things, you want to own like whatever Chris makes, I want it, then yeah, consider like the VIP all access stuff. Support or our sales team might have contacted you these last couple of weeks, maybe. But again, like there's never pressure for me. Like I want people that are going to be, excited to trade, ready to trade, having a variety of strategies, tackle the market up, down, sideways, near term, like zero DTE to, medium, long term from weekly to monthly, quarterly, yearly. I'm going to trade every possible way that I can. My philosophy in trading is whatever it takes. Honestly, like it's whatever it takes. I don't care what I have to do to carve out dollars and percentages and profits for the year. I don't care what the market throws at us. We got to figure it out, you know? So that being said, whatever I build, whatever I do, whatever services I run, that is my goal. I'm trying to make money, right? So what I'm using is I'm getting more and more refined. I'm trying to simplify a lot of the stuff where it's like I don't want anything about daily profit rate to be difficult. I don't want anything about waterfall income to be difficult. I want us to understand like there is a reason why we take these trades, and it's very straightforward. We learn the core strategies. We have the proper environment to trade them, or we have the flexibility within these strategies. Like, do we have to be bullish, bearish, and make a directional play in daily profit play? No. Every single day we can trade market efficiency, right? Waterfall income, we've survived 20+% crashes for the last decade and still made money. Silky smooth equity curve. Double ups. If we've got good order flows, we can find some really nice profits on double ups. It does get a little trickier in the 0 to 1 day, but when you pin those prices, you can get some big fat returns like 5x returns, 3x returns. A lot of those trades we close out for like 150 to 200% gains. So anyway, pinch point scanner, we've got a ton of trades running right now out to probably May. So we have like staggered expirations from February, March, April, and May. All we need is volatility on those positions. So those will be some pretty good trades rolling into 2026. New trade service coming in 2026, like I'm excited about. I'm going to focus on weeklies and monthlies. Set it, forget it. Really easy levels to focus on, and reward to risk that is 1-to-1 or better. Okay, crash insurance. I still need to find a good hedge for 2026. I haven't quite decided how I want to do it. I probably am willing to spend about 1% of my account on hedges as long as I'm getting like a 5-to-1 or 10-to-1 hedge. And even that might not pay out, but I can easily sacrifice 1% to have, maybe a 5 or 10% buffer for some forgiveness, right? So, because look, the tail side of 2026 is crazy. It's like I've literally seen people calling for a 20 to 40% correction or a 20 to 30, 40% upside, and it's like that shouldn't even be something you can publish and say like this is what I think.
Yeah.
It's like that's so bad to think like how is an investor supposed to take that information and then decide what to do with it? Like, do I position for a 40% correction? Do I position for a 40% upside? Those are terrible trades. The probability of both of those are terrible. So what do? Well, you grind through your strategies and you let the market kind of give you like one hand at a time. And all of a sudden the market tells us, okay, this is probably what's going to happen. But going into a brand new year and a clean slate, nobody freaking knows. I don't care if you're a 30-year macroeconomist that used to work for the Fed or Goldman Sachs or JP Morgan, you don't know anything more than what the historical averages give us, and the market's going to be up or down maybe 5 or 10%. It's like somewhere in the middle. It's like we'll discover that the market did this in 2026. We'll talk about it, right? And like I said this morning, it's either going to be like, drifting higher, or it's going to be like a blow off top, or it's going to be a correction and a rally, or it's going to be worst case scenario. It's like we roll over and we don't come back. But that's a lot of scenarios to think like, I wonder how I trade that, because it's literally all over the place. So you can't really trade it except day by day, week by week, month by month, and just make good, clean decisions. So every day, every week, every month, we take it in stride. We never, overcommit, and we will figure it out. And that's what I've been doing for, 15 years of managing money and 25 years in the market, is just trying to figure it out, but getting better and better, just simplifying, more refined. So anyway, Blake, let's go ahead and play and fire up some waterfall income. We had a good session yesterday, so check that out. I will be teaching master classes in the next couple of weeks on most of these services. And then I'm really excited about, I think